All right, so we're going to start talking about stuff. As you guys are all talking about what you hope to learn today, a lot of that isn't in my presentation. So I ask you to please put a pin in the questions that you have, specific questions. We'll get through the presentation, and then we're going to come back and circle around to the questions and answers that pop up, right? The way I organized the topic is go through the basics of retirement accounts, go through 4 tips that I think folks can use to better use their retirement accounts. And as we get through the end, it'll be obvious that we didn't cover everything. We'll circle back around to the questions that everybody has. Does that make sense? Next slide. These are all disclosure statements. The main thing is none of this is individualized investing advice, right? We're talking broadly. The charts and stuff that are up on the board, I think are accurate. Do your own due diligence whenever you're investing, all of that good stuff, right? All right, let's start with this. I used this quote in the December meetup group, but I just wanted to say it again. Along the lines of not regretting what you haven't done already. Someone's sitting in the shade today because someone planted a tree a long time ago. Planting the tree can start now, right? So wherever you are, maybe you planted that tree a long time ago, maybe you're just starting now. But the whole point of investing is that over long periods of time, we can use time to our benefit. So using retirement accounts. We're talking about this because most of your saving and asset growth will probably be done in 1 or more retirement accounts. That's how most people accumulate wealth during their careers. You're setting aside some portion of your paycheck, and so your assets are living in that retirement account and growing in that retirement account. Retirement accounts are special. So you get valuable tax benefits by putting your investments in retirement accounts. We're going to talk about that more specifically in a second. The account itself is a tax shelter. So the other day, I was talking to Christian about retirement accounts in preparation for this meeting, and he said, oh, they're like a shoebox. They're the shoebox. You put money in the shoebox, but the account itself is not the investment. Does that make sense? It's the tax shelter. You put money in, then you have to choose what the investments are. But the account protects you from taxes. That's what makes them special and powerful. So there are employer-sponsored accounts. So if you work for someone else and they have a retirement plan that might be called a 401k, it might be called a 403b, it might be called a 457, it might be called a simple IRA. These are plans that are attached to your employer. You get access to them through your employer. The different numbers are just different portions of the tax code that they're named after. 401ks are private companies. 403bs, if you're a teacher, you have a 403b. If you work at UT, you probably have a 403b. 457, public employees have access to a 457. And then simple IRAs are plans for small businesses. So if you work for a company that maybe has 10 to 100 employees, you might have a simple IRA instead of the other ones. You have self-employed retirement accounts. So for those of you who are self-employed, the main 2 that are used are a solo 401k, which is a 401k plan set up for you on your own if you don't have any employees, and then a SEP IRA, stands for Simplified Employee Pension IRA. So we'll talk a little bit about more of those going forward too. And then if you don't have any of those, you would have access to an individual retirement account. So there's a traditional IRA and a Roth IRA. Are there any questions about these 3 different types? Okay, perfect, then we'll keep going. So Roth versus traditional. The main difference is when your money is taxed. That's the main difference. Go ahead, Christian. In traditional accounts, contributions go in pre-tax. So you get the tax savings today. Your investments grow over time, and then the distributions are taxable when they come out in retirement. So that is the order in which things are taxed. You don't get taxed first. That money goes in the account. It grows and grows and grows at retirement age, which from the IRS's perspective is 59 and a half. When the money comes out as a distribution, then it is taxed. So that is versus, the next slide is Roth accounts. It's the opposite. Contributions go in after tax, so you pay your taxes today. That net amount goes into the accounts, it grows and grows and grows, and distributions are tax-free when they come out at retirement age. So those are the two different kinds, traditional and Roth. Most of those account types from the first few slides, most of those are offered in both of these versions. So if you work for a company that offers a 401k, that company might also offer a Roth 401k or a 403b and a Roth 403b. You know it's a Roth if it has the word Roth in it. If the word Roth isn't there, it's just a traditional account. Any questions on that so far? All right. So optimize number one. I know that doesn't make sense. It's horrible grammar, but it's just I wanted to use the word optimize. So I think the first thing that people can do is be as aggressive as they can be, right? Like those of you who know me know I talk about stocks all the time, and so this is where we're going to be talking about that. Be as aggressive as you can in these accounts. All right, so a lot of you have already seen this slide, but I'm going through it again because this is probably the most important slide there is. So compounding growth over time. So I'm going to run you guys through some different scenarios, and we're going to see how being aggressive pays off versus being conservative. So up here in the upper left-hand corner, we have present value of $10,000. I'm going to back up a second. In time value of money, there's 5 inputs. Time value of money is the basic building block of finance and investing. You have 5 inputs: present value, future value, payment either into the account or payment out of the account, number of years that you're compounding, and your rate of return. That's based on what you're investing in. So what you do is you assume, make assumptions for 4, and then you solve for the 5th using a financial calculator or Excel or a Google calculator. You can just Google time value of money. So I'm using my financial calculator. Let's say that you receive $10,000 from someone. So you have $10,000. That's your present value. Let's say you find an account that will give you a 5% rate of return and you invest in that. So that's your R, your rate of return. You don't put any more money into this account and you let it grow for 10 years. When you compute your future value, you'll come back in 10 years and your account will be worth $16,289. If I had a whiteboard, I would write that on there. Okay, so a little bit over $16,000. If we change our assumption and say, okay, instead of investing for 10 years, now we're going to invest for 30 years. So this is, most people, kind of a preparing for retirement timeline. If we change our N to 30 and compute the future value, now we come back and the future value of that account is $43,219. So that makes sense, right? The money is growing for longer, so it should be worth more after 30 years than after 10 years. We go from about 16,000 to a little over 43,000. So now the main assumption that we're changing, we're going to go to the bottom left. Instead of investment that returns 5% a year, now we're targeting an investment that returns 10% a year on average. So we come back and we change our rate of return to 10, and we're going to go back to a 10-year time period. When we compute future value here, we come up with $25,937. So that makes sense too, right? The investment that we've chosen has gotten a higher rate of return. We end up with more money. So the difference is about $16,000 to about $26,000, just from a higher rate of return. So if we come down to the bottom right-hand corner there, now we're starting with $10,000. We're never putting another penny into this account. We are choosing investments we think will hit a 10% rate of return, and we're doing it for 30 years. So now we calculate our future value. And for those of you who maybe haven't seen this example before, though now I'm looking around, I'm like, you've all seen this example before. You're like, moving on, Sarah. Does anyone know what it would be? Lynn, you want to try? Do you want to guess? That's a really good guess. So 100,000 is a good guess. But the number is actually $174,494. So almost $175,000. So this is really important for everyone to internalize, right? Every time I get up here, every time any of you have seen me talk or talk to me in my office, I've talked about this every single time. I can almost guarantee it. The rate of return over long periods of time is what works in your favor. Over and over and over again, I hear people say, I'm conservative, I'm conservative, I'm conservative, I don't want to take any risk. If you don't take risk, you're going to have a hard time getting a high return. And that's fine. Just know that as you're saving for retirement, you're going to need a certain amount of money to fund your retirement. You can do it yourself through saving, right? Here, you're asking your investments to do a lot of the growing for you. Most people, it's kind of people don't think of it this way, but most people can't afford to be conservative, right? You probably can't save your way to a nest egg big enough to support you. So a lot of people need to be more aggressive. You need to be targeting a 7, 8, 9, 10% rate of return versus the 1%, 2%, 3% in your high yield savings account and a bond fund and your residential real estate. Those lower rates of return aren't going to work as hard for you. Are there any questions on that? You cannot be, the worst thing you can do is be conservative and not save money. You will not have enough. The best thing you can do is be aggressive and save a bunch of money. Then you will have more than you could ever spend, right? Most of us are going to fall somewhere in between. You're going to save some money, and then you're going to have to figure out how far out can I go on the risk spectrum to get a rate of return that lets me fund the retirement that I want, or the life I want, if you're just looking for financial independence. And so these are the numbers that we do in my office. Like, what are those numbers for you? Yeah?
Is that an annual rate of return, like over time, or equal out?
Yes, it's called a compound annual growth rate. So the stock market never returns 10% a year, right? Sometimes it's negative 30. Sometimes it's positive 35. But over history, and we'll look at some stuff, over history, it averages out to 10%. In the past, it has averaged out to 10%, right? Nobody knows what's going to happen going forward. But in the past, it's been about 10%. But it comes in fits and starts, right? It's like horror, and then it's fun, you know? Are there any other questions on time value of money? All right. So we'll keep going. So this is going back to optimizing your retirement accounts. Your retirement accounts are for retirement. You can't touch them till you're 59 and a half anyway. So do you have a long enough time horizon to be aggressive? So choosing investments. So this is going towards that R number, that rate of return. It's directly related to what you invest in. So how do we choose what we're going to invest in? Ask yourself 2 questions. When do I need the money? Can I tolerate big swings in price? Those 2 things will get you pretty far as to what you should be investing in. Stocks have higher returns over time, but the price bounces around a lot in the short term. Bonds have lower returns over time, but their prices are more stable. Stocks require a very long holding period. So we'll see some charts going forward. That 10% compound annual growth rate happens over decades and decades, right? But if we're trying to do a forecast as to what the stock market will do in a year, or 5 years, or even 10 years, it could be any range of numbers. So this is where you have to really know yourself. When do I need the money? If it's a long time from now, and remember, retirement is long. So even if you're getting ready for retirement, you have to be thinking through to how long retirement is. When will I need the money? And can I tolerate big swings in price? If the answer is a long time from now and yes, then stocks are for you. If the answer is a long time from now and I can tolerate it a little bit, then you'll probably need a blend. So you have to figure this out for yourself. So what percentage of stocks versus bonds versus real estate? You know, most people have, if you own your home, that's going to be a more conservative investment. You have to figure out what percentage of those assets make the most sense for you. Are there any questions on that? I mean, that's the hardest part. I'm like, oh, do you have any questions? I mean, you should have questions, right? Because this will be the main part of putting together your own financial plan and how you're managing your retirement accounts. But those are the 2 questions you need to be asking yourself.
One thing that strikes me is the idea of being aggressive with your retirement fund, but yet with the last stock market crash, we heard tons of stories about people losing their retirement. Mm-hmm. And so that's why it sort of seems like an oxymoron almost.
Yeah.
But I guess the idea is that that was them because they were at retirement age or a couple of years away versus somebody who's 20, 10, 30 years away, that it should all even out over that very long time.
Right. I mean, and that's a really good point. If you think back to where you were in 2008, 2009, maybe your own experience or people you knew, that's going to go back to these two questions. When do I need the money? If you were retiring in 2007 or 2008 and you hadn't carved out some money to live off of, and it's 2008 and now you're selling stocks 50% down to fund your retirement, that will destroy your financial plan. When do you need the money? If it's less than 5 years, that money is not in the stock market. Not anywhere close to the stock market. Can I tolerate big swings? So that's the other piece. If you're getting ready for retirement or wherever you were in 2008, 2009, if your instinct is to sell and just get out and make the pain stop, and you actually do that, that's the other way you destroy your retirement. We're going to talk about this later on. You know, the goal of investing is fairly simple, not easy, but it's buy low, sell high. And we talk about like people do the opposite all the time. You get really excited. The market's up. Let's see how long it keeps going. The market's down. Oh my God, it's going to go to zero. I'm going to have nothing. Let's sell. That is where that can I tolerate big swings in price comes in. What can you tolerate? If you know that it is going to scare the bejeebers out of you to see your stock go down by 50%, you need to dial it back a little bit, right? So these two questions, keep them in your mind when you're thinking percentage of stocks, percentage of bonds. The bonds are there to be stable when stocks go down. Bonds aren't going to go up a lot, but they're not going to go down a lot. So I think that's a really good point. Yeah.
So for stocks, is it 10 years is kind of the...
Yes.
Okay.
I mean, yes, I think 10 years is probably the minimum where you can get some visibility, like, they'll probably be up over a 10-year time period. No guarantees. They'll probably be up over a 20-year time period. Your probability is better. Than over 30 years, hopefully we're getting closer to that 8, 9, 10% number over 30 years. But you need to have money not in stocks if you need that money in the next 5 years or less. That's really important.
So if I invest in an account now it's 12% average, should I draw money and then switch them down?
Can you come back and ask me that towards the end, like what you could do now? Like we'll come back to that. That's a good question. Yeah.
So is there some kind of pie chart with that last sentence there based on where you are, like close to retirement or not? Like how much you should have in stocks, bonds? You're saying now if you're retiring in less than 5 years, you shouldn't have any stocks?
No, the money that you need in 5 years. So that's a really important distinction. So if you're going to retire in 3 years, my income will stop in 3 years. Then I have 2 years worth of living expenses that you want to carve out of your portfolio to make sure you have money to pay the bills for the next 5 years. Where does that money come from? It should not be in the stock market. If you're planning on using the money to pay the bills at some point, or buy a house, whatever it is, or pay for college, whatever it is, that money is not in the stock market.
You should have enough money in cash somewhere.
Yes, cash or something very low risk. Yes, yes, yes.
So have you heard, and I wanted to hear what your thoughts were on this, have you heard like the rule of Wall Street that like whatever your age is, that's the percent your safe investments should be, and the remainder is the percent that your aggressive investments should be?
Yeah, I've heard of the rule of thumb. I think it needs to be a little bit more nuanced than that, right? Like if someone's coming in, they say, okay, I need $50,000 a year to pay my bills, and I'm retired. Great. Do you have $250,000 set aside, not in the stock market, that you can use to pay the bills if something horrible happens? That might be way too conservative for some people. Maybe you don't,
So like if I'm 60, then maybe 60 would be in safe investments. Maybe they don't grow as aggressively. And then maybe 40% would be something more aggressive.
Maybe.
Depending on what I need and when I need it.
Yeah, I wish I could go to the whiteboard, but I don't have a whiteboard and I'm chained. But one of the things you can do is do a weighted expected return. right? It's weighted. So if you are 50% stocks, 50% bonds, and you assume that the stock market returns 8%, and you assume the bond market returns, let's just say 2%. Now you have a 5% expected return for that portfolio, right? You can't really expect it. You might get lucky, maybe it'll return more, maybe it'll return less, but now you have an expected rate of return of 5. So you can back into, again, how much do you need the money to grow for that time value of money calculation you needed to meet your goals. We can come back to this, the choosing investments and tactics and strategies, maybe a little bit later. But I think those are really good questions. So here's my risk versus return chart that a lot of you have seen before. So this is looking at 7 different asset classes from 1970 to 2016. One of the things in finance that people always say is the past is not indicative of future results. Past performance is not indicative of future results. Really well known, which means don't count on the future to be like the past. But the future is all, or the past is all we have to go on for what our expectations are, right? So in the past, cash, down here, what we have is, how far can I go? All right, on the x-axis, we have something called standard deviation of annual returns. In investing, that's a measure of risk. It's more or less a measure of how much the price of an asset bounces around. On the y-axis, we have that compound annual return, so that R. So the general relationship is if you don't take a lot of risk, you shouldn't expect to get a very high return. So down here we have cash, I don't know if you can see that, cash, and US bonds. So conservative investments down here. As you come over to the upper right-hand quadrant, we have large US stocks, commercial real estate, small US stocks, and then down here, these two that are hanging out in the bottom right-hand quadrant are international stocks and commodities. Commodities are like raw materials, oil and gas, things like that. So there's this relationship that you can kind of eyeball. Okay, cash and bonds, you don't take that much risk, but don't expect to get a high return. That's not the way it works. If you go out on the risk spectrum, over the last roughly 46 years, you have gotten a higher return with a lot of volatility. And then in the case of commodities, you took a lot of risk, you didn't get as high a return as you would have expected based on the risk that you're taking. But if you just think stocks in the upper right-hand quadrant, bonds in the lower left-hand quadrant, that's the relationship to think about. And that's also where that 10% number came from, right? Like, did the market actually return 10%? Can we actually expect it to return 10% in the future? I don't know what's going to happen in the future, but based on what happened over the last 46 years, that's where that number comes from. It's actually 10.3. Some portion of that is the price growth of a stock growing in price. And about 3% of it is from dividends that you receive from owning those stocks. So this is what we're just using to make decisions going forward. No guarantees ever. That's what investing is. Yeah.
Is just looking at U.S. markets?
Yes, from a U.S. perspective. So on the international stock side, if you are a U.S. investor investing internationally, you're exposed to currency risk, right? So that's a factor there in that risk-reward trade-off from a U.S. investor's perspective.
And the equally weighted diversified portfolio, is that all the components in that chart?
Yeah, so we talk about this in Investing for Beginners, one of those classes that people were talking about. We talk about putting stocks and bonds, putting all 7 of these asset classes into one portfolio, and you actually end up where that red diamond is, with a portfolio that returns almost as much as US stocks, but with much less risk. Are there any questions on this? Yeah.
I just have one question. So when you're trying to calculate how much you should have, are you thinking, okay, I need $500,000 because if I divide that by 30, if I'm going to be retired for 30 years maybe, then X amount of money per year will be out of that? Or do you think, oh, I'm probably going to get 4%, year one of retirement on, so it's not that I'm taking my principal, it's just that I want enough money so that the percentage is what I need to live on? Is that?
So it's somewhere in between. In an ideal world, we would all have this pot of money, and we could generate enough income from that principal to live off of, right? And never have to touch the underlying. That would be awesome. That's what financial independence is, but it's probably not where a whole bunch of us are, right? And that's okay. So you do the time value of money calculation. Okay, I'm going into retirement with $500,000. I'm assuming it's going to grow 4 or 5% a year. I need this to last for 30 years. I'm just going to spend all the money here. I'm going to assume my future value is 0, and I bounce the last check I ever write. And then you can calculate that payment number. According to time value of money, how much can I afford to take out of this account every year? That's a starting point, right? Because then real life happens, and you're adjusting accordingly. But that's the starting point, is using that time value of money. I'm assuming, my investments are going to grow in the first part of retirement, but you're taking some of the income and growth and some of the corpus, some of the principal out too. That's where most people are. That's what a financial plan should hopefully lead you to. How much can I afford to take out in retirement? Really good question.
Another question, is that equally weighted? Is it meaning all of those 7 investments have equal amounts in that portfolio?
Yes, 14%, and then rebalanced annually.
Oh, okay.
Yeah.
Alrighty. Okay.
Great. And down there at the bottom it says email Sarah for more detail if you want to know where the numbers come from. So if you are investing, so back to the retirement accounts, coming up with this right balance of stocks versus bonds. If you don't really want to do this, a lot of retirement plans now have a list of target date funds to choose from. So they're trying to make it easier for you to get out on the risk spectrum. So a target date fund is a mutual fund that owns different asset classes, stocks and bonds being the main ones. And you just think about the date you want to retire. So the target date funds takes that date that you give it, I want to retire in 2040, and it chooses your stocks bond mix for you, and then it automatically reduces your exposure to stocks as you get closer to retirement age. So if you're like, just give me the easiest answer, this is it, okay? This is like, just buy this target date fund and you don't have to really learn anything else. So here, Vanguard has these 2 different retirement funds. I just wanted to show you the different allocations. So that's the pie. Over here, Vanguard Target Retirement 2025. So that's assuming you're going to retire in the next, how many years is that? 9 years? 8 years? The asset allocation was about 65% stocks, 35% bonds, right? Over here, if you push your retirement age out to 2040, it's giving you an allocation of about 90% stocks, 10% bonds, right? The general idea is if you don't need this money for a long time, as long as you're not going to sell in the middle of a crash, you should be exposed to stocks to get the most growth possible. Does that make sense? Yes. So one-stop shopping. If you have a 401k, I'm pretty sure you have something like this available to you. Okay, so that's a good place to start if you don't want to give any more thought to it at all. They're good options. All right. So optimize number 2, increase your contributions. So this is saving more money. Go to the next one. Small changes have big effects, so with time value of money, especially over long periods of time. So here, let's say you're starting your 401k from scratch. You've never saved anything for retirement before. And you're going to save for about 15 years, so that's 180 months. And you're targeting a rate of return of 7%. So that's a blended portfolio, right? Not 10%, but not 5%, somewhere in the middle. When we plug that in, or if we start with $500 monthly contribution, so $6,000 a year is what you're setting aside in your accounts. Your future value after year 15 is about $158,000. And after 30 years, it's almost $610,000. That's great. That's $500 a month. Can you find that? If you increase your contributions by just $100 a month, you end up with more money. Right? But it's it seems like a lot more money based on $100 a month, right? That's what is so powerful about time value of money. It's this little change that compounds. That's the power of compounding. You make this tiny change today, and you end up with a lot more money, right? So what can you do to optimize your accounts? A lot of people come through my office and aren't maxing out their 401ks. They're not maxing out their IRAs. It just doesn't, there's other things to spend money on, right? And that's cool, but maybe you can find an extra $100 a month, or maybe you can slowly over time push up against that limit to what you can put into your retirement accounts. Like, challenge yourself to do that. You will not be sorry, right? Like, I think one of the main pieces of advice that people who've been doing this a while give to people who are just starting is don't wait. Don't put it off. Do it now, right? You can always stop saving down the road if you have too much money. All right? You're like, I have enough. But you can't get those years back. Your time is really valuable, so don't forget that. Yeah?
I've always wondered, does it matter when you contribute? Like, for instance, I'm in the habit of once a year, and I always think, like, should I do it monthly or quarterly? Would that make a difference?
Yeah, that's an awesome question. The answer, according to finance, is yes. The earlier you do it, the better, right? So yearly, you're not getting the compounding benefit for the first part of the year. Monthly is better. Bi-weekly is better. Daily is the best, right? And so daily is what they're doing on your credit cards, right? They're doing it daily. Of course, you're not going to do it daily, but the more often and the farther, the faster is better. Just in finance in general, you want the money coming into you to happen faster and the money going out to be slower. But you also want to front load your payments to yourself, right? So you have that much longer for them to compound. Even if it's just a few days or annual versus monthly, it's going to be a difference. So yes, if you can set it up, if you don't have to wait, then don't. That's another small change that you can make that will make it'll make a difference. Yeah.
That's a good question, because I'm self-employed too, and I do the same thing.
Yeah.
At the end, at tax time, you put money in your SEP.
Yeah.
But you're saying that if you do it every month, and you can contribute every month into a SEP, it's much better compounding.
Yes. And so being self-employed myself, like, I get the cash flow concerns, and also how much can I contribute? I don't know how much I'm going to make this year, all that stuff. If you can get around it, guesstimate what you think you'll be able to contribute for the year, and then do it on a monthly basis, you'll be better off. If you over-contribute, you just call your broker and you say, oh, I put in too much. They'll send you a form and say, okay, back out your excess contributions, pay the tax on it, no harm, no foul. So you can get it, you can fix it. It's an easy fix.
Thank you.
Yeah. All right, any other questions on this? Yeah.
Are there other options than 401k and IRA if your employer doesn't have a 401k?
That's a really good question. If your employer doesn't have a 401k option, you are limited to the IRA. So it's a $5,500 limit. We'll get to that there. So you'll want to open an IRA. And then what you'll want to do is, if you have excess contributions that you can be saving for retirement, don't not save it. Put it in a brokerage account and earmark it in your mind for retirement. So for me, it would just be a regular brokerage account that's not a retirement account in my name. So Sara Glakas' individual retirement account. Just because it's not a retirement account doesn't mean that doesn't mean I can't let it sit there and grow for 30 years, right? So if you're limited to what you can contribute to, don't not save just because of that, right? You're gonna have to find a workaround. Good question. Yeah.
What are the pros and cons of doing that in something like Wealthfront Betterment? I think that's what you're referring to, right? And versus doing the SEP, or like if you are individual.
Can you ask me when we come back to it? Because we'll go through some of the SEP stuff and then ask me at the end. Good question. All right, we'll go to the next slide here. So your 2017 contribution limits. For your 401k, your 403b, 457, so most of your employer-sponsored plans, your pre-tax contributions, it doesn't matter if it's pre-tax, your contributions, whether it's a Roth or a Roth or a traditional 401k, your contributions as the employee can be up to $18,000 a year if you're under age 50, up to $24,000 a year if you're over age 50. That's a lot, right? That's a lot of money. So, If you're lucky enough to work for someone who's matching your contributions, that's on top of this, right? This is your employee contributions. You can put in up to that much. The simple IRA, that has slightly lower contribution limits. If you participate in a simple, your contributions can be up to $12,500 a year if you're under age 50 and $15,500 if you're over age 50. So you get this period of time to make catch-up contributions when you're over age 50. A SEP IRA, you can contribute up to 25% of your compensation, up to $54,000 a year. So that's a lot. If you're self-employed and you make a good living being self-employed.
The worst thing. I just can't spend a single cent. Because at least you give a cap that's like reasonable.
It is a lot of pressure to hit your limits. Yeah.
What is compensation? What
It's
line?
like your net income,
Okay.
more or less. Your CPA will calculate it for you and tell you how much you can contribute. And then for IRAs, so if you're not self-employed and you don't have an employer-sponsored plan, then your contribution is up to $5,500 a year if you're under age 50, $6,500 if you're over age 50.
So what if you have a 401k and an IRA? Can you do 18 and then 12?
Maybe, but probably not. So down here at the bottom, check the irs.gov for income limits on contributing to IRAs. For Roth IRAs, at some point you make too much money to contribute to a Roth IRA. It's somewhere around $118,000 for individuals, $184,000 for married filing jointly. And for contributing to a traditional IRA, the income limits are a lot lower. So think about it like this. The government doesn't want you not paying taxes on too much money, right? Because all that pre-tax, these traditional accounts, you're not paying the taxes today, you're putting it off for the future. You can do that to a certain limit, but at some point they're going to be like, no, we need that now. So it's a much lower limit. If you have a 401k available to you at work, you stop being able to get a tax deduction for your traditional IRA somewhere around $50,000 or $60,000. So you probably can't do it, but you'll want to check. Yeah.
So is it a good time now to talk about the back door?
Yeah. Yes, so backdoor contributions. So once you make too much money, you're not allowed to contribute to a Roth IRA anymore. There is a workaround to that might work in a special circumstance. So if you make too much money to contribute to a Roth, then you certainly make too much money to contribute and get the tax deduction on a traditional IRA contribution. But you can still contribute to a traditional IRA post-tax. Does that make sense? So you can put post-tax money into a traditional IRA. Well, now that you've made that contribution to a traditional IRA, now you can do something called a conversion, where you can convert a traditional IRA into a Roth IRA. All you have to do is pay the taxes. But you've already paid the taxes because it's post-tax money. Does this make sense so far? You with me? So you could theoretically turn around and move that $5,500 contribution into a Roth, even though you make too much money to contribute to a Roth. It's called a backdoor Roth.
And you wouldn't own any more taxes on the conversion process.
Right. If you invested in something and you put in $5,500 and it grew to $5,600, you would owe taxes on the $100 in gains. So this sounds pretty good, right? The problem with this, the trick that most people have, is if you have any other traditional IRAs, the amount of money you convert to a Roth is pro rata between the pre-tax money and the post-tax money. So if you have a $5,500 contribution that's post-tax, and you have $100,000 in a rollover IRA from your previous employer, most of that conversion to the Roth is going to be taxable, right? So that's where it is. That's where the hitch is. This works awesome for people who have all of their retirement savings in a 401k. And then they open a traditional IRA, and you can do this little backdoor maneuver, which is kind of in a gray area of tax law, by the way, so I'm not advocating this. It kind of sounds like maybe the IRS isn't cool with something like this, right? It happens. But that's what a backdoor IRA is. And we'll talk about conversions a little bit later too, just in general. So you can kind of get around that limit if your circumstances permit. Are there any questions on contribution limits? All right, then we will move on. So optimization number 3, that's the word I should have used, optimization. Reduce your fees. So we'll go on. So ways to reduce your fees. This really becomes something you can really look at in your 401k. You don't choose your 401k, someone has chosen it for you, right? So really look at the plan that you have through your employer. Know the management fee associated with the mutual funds you're buying. Is it worth it? So we learn about this in class and in other meetups. You have mutual funds that are passively managed. They track an index, the S&P 500 is a very famous index. Index funds are, generally speaking, very inexpensive. Then you have another group of mutual funds where someone, a person, is choosing the investments that go in that fund. You have to pay that person and that person's team and pay for that person's equipment to do all this analysis for you. So those types of funds tend to be more expensive. If you buy an actively managed fund, just make sure you're getting what you're paying for. So you can get a list from HR of what the fees are on the mutual funds that you have available for 401k. That it has to be made available to you. Try to find the cheapest ones. Use index funds. So if they're available in your 401k, look at those first. If you buy something more expensive, make sure you know why you're doing it. If you are doing an IRA or a rollover or a SEP or something else where you can control where the money is held at whether it's Schwab or Vanguard or E-Trade or whoever, use index funds. Index funds are pure exposure to an asset class. So what that means is if you know your portfolio is 60% stocks, 40% bonds, you can pick an index fund that's very inexpensive that gets you exposure to 3,500 stocks in the US, and you'd pay pennies on the dollar for access to that fund. Does that make sense? Versus paying someone extra to do better than those stocks might do on their own. One thing you can do, I think this is a kind of a cool hack, is if you have those target date funds in your retirement account, they're often kind of expensive. They might charge you 0.79% just for putting this fund together for you, or maybe it's 0.85%, whatever it is. You can go in and look at the pie and say, oh, all this is 60% stocks, 40% bonds, and then you can go back to your list of funds and put 60% of your portfolio in stocks and 40% in bonds. Yeah, just unbundle it. Yeah.
So I did that recently with my 401k because I had it in the target date fund. And when I calculated, I saved like $800 a year, which is significant.
Yeah.
So
How much time did you spend on it?
maybe 2 hours, me and a friend.
Yeah.
Both doing it with our 401k.
Yeah.
Trying to look at the fees.
Yeah. I mean, that's awesome. You can do that, right? So the target date funds are the first option if your other option is do nothing, right? So do nothing, not an option. Target date fund, okay. But here, if you take 2 hours, take apart your target date fund and reassemble it with something else, something cheaper, you can save yourself a lot of money. That's awesome.
Are you able to see on a target date fund what are the actual stocks or what are the actual bonds that they're investing in? I never looked into this, unbundle the target date.
So if you use Morningstar,
Yeah.
each fund has a ticker symbol. It's 5 letters long. Put the ticker symbol in Morningstar and then go to the tab that says Portfolio. And in there, it will show you what that target date fund is made of. And then can you figure out how to reassemble it on your own, but cheaper. So this takes time, right? Like it takes time and it takes effort to do it. But for $800, that sounds like it might be worth it, right? Per year, right? And it's going to be more because your account's growing over time. You're adding to it, right? So that's a cool little hack that you can do. If you are looking at all your options and you're like, oh, these stink, you can call HR and tell them that you want better options. A lot of times, they don't know that the plan stinks, right? They're not investment professionals. They don't know. They're like someone came in and said, oh, look, like you can offer this benefit to your employees and they're trying to do the right thing, but then all those mutual funds are like 1.5%, 1.7%. Just call them and say, can we get more index funds included in our plan? And a lot of times they'll try to work it out for you. Exactly, they have the same thing, yeah. Just know that smaller companies don't have as much pricing power as larger companies, right? So if Black Barn Financial is calling up and like, hey, can you give me the best, the lowest cost mutual fund? They're gonna be like, no, you're not big enough. But if you're UT has bargaining power, so all the funds that they offer are super, super, super low cost. So, but you can lobby on your own behalf, right? Can we make this better? Can we get better options? And then, get advice from someone. This is kind of self-serving, but I think that if you have a question, like get advice from someone who can help you do this, who can look at your plan or look at what you have in the accounts and say, oh, like these are the changes I would make and why. Yeah.
So when you say management fee, I just want to make sure I understand what that is. So what I believe that is if I look at the fund, like if I'm with the group of like American Mutual Funds or something, then they charge a fee, like the fund charges a fee. But then if I work with someone like a financial advisor, they have a fee as well.
Yes.
Okay.
So the management fee is what the fund is charging you to put the fund together. We've packaged these up for you. Now you can buy access to this package from us for a fee. That's in addition to any commissions that you might be paying to buy this thing, any advisory fees you might be paying go on top of it.
And is there a rule of thumb for the management fee, like don't go over 2% or 1%?
Oh my gosh, certainly not 2%. Like there's so many really good options. For me, the benchmark starts with Vanguard, right? Vanguard is set up to do low cost index funds. Everyone in this room could get access to an S&P 500 mutual fund from Vanguard that charges 0.17% of the amount that you own of that fund. Does that make sense? So 0.17% is the starting place. The funds that you're offered in your 401k might be more expensive than that. So just pick the cheapest ones. But if you're kind of out in the world, that's your benchmark. If someone is charging you more than 0.17%, why? Is it because it's a great strategy? Is it because it's something that's more niche, something that's more suited to you, something like that? Just know why you're paying more than that. Did that answer your question?
Yes. I have a question.
Oh.
So you're talking about index fund for a while, but I was kind of curious. How do you feel about ETF? Because sometimes they're kind of similar. I mean,
Yeah.
it's kind of start like. I just feel like index fund sometimes is more expensive fee-wise.
Yeah, so the question is about ETFs. That stands for exchange traded funds. Exchange traded funds are more or less cousins to mutual funds. It's the same general idea as a mutual fund where you have a basket. There are stocks or bonds or stocks and bonds in the basket, and you're buying a piece of the basket. Does that make sense? A lot of ETFs are a little bit cheaper. They're also more tax efficient. So, but ETFs generally aren't available to people in their 401k plans. So because we're talking about retirement accounts in general, I keep using the term mutual fund. But if you have access to ETFs and you want to use ETFs, I think ETFs are great. Did that answer your question?
I just wanted to let you know.
All right, number 4, converting from a traditional to a Roth in low income years. So we kind of touched on this already. So if you have a low income year, for whatever reason, you take a sabbatical, you retire, you just do something where you don't have as much an income that year, ask your tax prep person to estimate how much tax you'd owe on a conversion from a traditional account to a Roth account. The idea is that you pay taxes on that traditional money today at a lower rate, and then you put it into the Roth IRA, where all that future growth will be tax-free. So this happens quite a bit with job changes, right? You just have a year where you take half a year off, or Maybe you go from 2 incomes to 1 income for family reasons. And you're like, oh, well, we're not in a very high tax bracket this year. Think about those traditional accounts that you might be able to convert, right? Maybe you get to convert it at a 25% tax rate instead of the 33% tax rate you were in. And now you get that money from that pre-tax account into a Roth account, and now it can grow and grow and grow and grow. You never have to take the money out, and you don't have to pay taxes on anything that happens in that account. So that can be something cool to think about just as you're going through your career. It's a good idea to get advice on that before you do it. Get some numbers before you do it to see if it's a good idea. Are there any questions on that? Does that make sense? Yeah, Alice.
To pay the taxes on it, can you use the money that's in the traditional account, or do you have to have like separate cash for that?
You can. So you can have it set up on the form that you fill out that you would like taxes withheld. And then the net amount is transferred to the Roth. Or you can choose to not have taxes withheld, and then you better have cash to pay the tax bill when it comes up. So that's maybe why you want to do some planning, right? Like, oh, shoot, I forgot I did that, and now I need $5,000 to pay my tax bill. Great questions. So number 5, use stock market volatility to your advantage. So what I mean by this is while you are accumulating for retirement, it's good when the market falls, right? When the market falls, view it as a buying opportunity. After all, the idea is to buy low, sell high. That is what we're trying to do. So often, your instinct is to panic when the market falls. And like, I do this for a living all day, every day. I get that feeling in my stomach. Like, it doesn't necessarily go away the more that you do it. You're like, oh, I wish this wasn't happening. But you can turn it on its head, right? It can be an opportunity. If you're contributing to a 401k, you're setting aside a chunk of money every pay period. So you're doing dollar cost averaging. When your contribution goes in, you're buying a certain amount of stocks, a certain number of stocks. When the price goes down, you get to buy more stocks with the same amount of money, right? That is really powerful here while the market is falling, right? You're buying more and more stocks. Now you have to have the confidence that at some point in time, the market will stop falling, right? It's not going to go to zero. And then you will have bought low, and then you wait and wait and wait and wait and wait and wait, again, because retirement or the time you need this money is a long way away, to sell high. So you can use volatility to your advantage. It almost becomes like a win-win. You're contributing, you're buying stocks. If they go up, great, you have more money. If they fall, great, now you're buying more for less. And you don't need that money yet, right? This is for some future time, way in the future. So this is your time to get a bargain. And it's easier said than done. I know this. Like, markets are at all-time highs. Like, people, the market falls by 1% and then everybody rushes in and buys more. But at some point, something horrible is going to happen in the stock market. And your instinct is going to be to stop contributing to your 401k. Or even worse, pull out of the market altogether. Like, do whatever you can to combat that feeling. I'm really hoping this group still exists and it'll become like a stock market support group at that point, right? Where we just like cry about things and try to pat each other on the back and get through it, right? Because like there were several people in the group, and maybe some of you did this, where I heard one woman, it was one of our first meetings, she's like, yeah, my 401k turned into my 201k, ha 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 ha. And she laughed, but she said, well, I just didn't really know how to log into my account and change things, so I just let it keep going, and now everything's fine, right? So like, you can use that to your advantage. You don't have to try to outsmart it. If anything, like, the dumber the better. It's like set up. You don't need to change anything. Like, it's going to be okay. You're making those decisions today that this money is for you way in the future. And it will take something so horrible to wipe out the entire US stock market. And I'm not saying it couldn't happen, but we're going to have bigger problems than that if the market goes to zero, all right? This is not a topic about gold or bunkers or anything like that, but so like, we're just using the past. Like, in the past, the US economy, it's resilient. Companies are growing, and then sometimes companies die, and new companies come out of that. That's what the ups and downs of the market are digesting. Yeah?
So I understand that you shouldn't get afraid to come out. But if you're looking over, let's say a year's period of time with a particular stock or mutual fund, and you say, you know what, it's not performing well. Shouldn't you move? Like, shouldn't you kind of assess it?
I mean, if you're pretty sure it's a real dog, and you put it somewhere better, then I think that that's okay. You're kind of making this tactical decision, like, whatever. Like, what's a good dyeing company? Sears. Like if it was Sears a year ago and you're like, oh, Amazon is not good for Sears, like this is not going to work out well for them. Let's like exchange our Sears stock for something else. Hopefully Amazon, yeah. Hopefully, yeah. Whole Foods just had its big turnaround. If anyone has been watching that dog for such a long time, and then Amazon came in and said, great, bargain, we'll buy that brand, Anyway, I digress. But yeah, something like that is different from pulling out of stocks altogether. People just get out of stocks altogether and go to cash. And then they hang out in cash and they don't have a plan for getting back in. Like that's really what it ends up being. It's like you go to cash here and then the market goes up and you're like, oh my gosh, I'm so scared, it's gonna fall again, it's gonna fall again, it's gonna fall again. Ooh, now what should I do with my cash, right? Like if the market has already come back. So it's really hard to outsmart it. So just hanging in there is the best thing you can do. Yeah.
Some of my coworkers recently were talking about how they put like this auto sell option on their stocks. So like if you feel like you can't take a certain amount of risk, then it'll automatically sell. So
yes, so it's called a stop loss.
Do you do that with your retirement accounts or just like?
I don't, because this is the thing. You're making a sell decision. What's your next decision after that? You sell your stocks and now you have cash. Now what are you going to do? What are you going to do with the cash? Was your intention to have a bunch of cash? I mean, the intention is to not lose more money on the stock, right? But then what do you now you've just created a new decision for yourself. What do I do with this cash? That's really hard. That ends up being the hard thing with stop losses. So I'm not a huge fan of stop losses unless if you have a huge gain and you're like, okay, I just want to lock in a big gain on something on Amazon, right? Like I bought it at 50 and now it's at 900. I don't want it, I want to sell if it goes to 850 and then move on to something else. That's one thing. You've made the decision, I'm going to exchange this stock for something else. But if you're just using it to protect your downside, I feel like it creates a new problem, which is what to do with that cash now. So if you have a plan, great. If you don't, you're just going to end up with a bunch of cash and maybe missing out on more upside. Did that answer your question?
Yes. I think you're better off having like a watch list of things you'd like to get, and then when the market takes a dip, then you can think about buying it if that went down.
Yeah, that's a great thing to have.
Something you're not liking so much that you have.
Yeah.
Yeah.
That's great. Great questions. So this is using risk in your favor, right? So just trying to make the stock market less scary. I think I just have a couple more slides left, and then we can go to question and answer. So this is showing the S&P 500 index back to January 1957. These are all the horrible things that have happened since 1957, right? This is the stock market going up and down through all those horrible things. Cuban Missile Crisis, yikes, that happened. In 1987, the stock market fell something like 20% in a day, right? The Persian Gulf War, 9/11, like all of these horrible things have happened. And life is uncertain, right? The stock market is forward-looking. People buy stocks because they think the future will be good, or they sell because they think the future will be bad. But there's no way to know. The market always recovers. It probably, without there being any guarantees, it'll probably recover in the future. Just think about, stocks are companies. It's ownership in companies. Companies are opportunistic, right? There's always money to be made somewhere. There's going to be a company growing to take opportunity of making money no matter what horrible things happen. The market can be horrible for long periods of time. I do not want to discount that. It took 5.5 years to get back to even during 2008, 2009. Just to get back to even, right? That's a long time. But that's where that 5-year time horizon comes in. How long are we planning for? Stocks are for those really long time horizons. Life is long. Good things happen, bad things happen. But here, this is just showing the market somehow comes back, even after really horrible things. So I think that's it.